Breaking tonight, a growing number of traders across global markets are asking the same unsettling question: why does price so often move against them the moment they enter a trade? From forex to stocks to crypto, the pattern is familiar: clean setups, clear confirmation, followed by sudden reversals. Market analysts say this isn't coincidence, it's structure. Before we go further, a quick reminder: this video is for educational purposes only. It does not constitute financial advice. Trading forex, stocks and cryptocurrencies involves significant risk, and losses can exceed deposits. Always conduct your own research and seek independent financial advice where appropriate. Modern financial markets are no longer driven solely by human reaction. They are dominated by algorithms, systems capable of analyzing millions of orders, behaviors, and probabilities in milliseconds. These systems are not emotional, they don't predict opinions, they identify patterns of behavior, and retail trading behavior creates data. Every buy order, every sell order, every stop loss leaves a footprint. When large numbers of traders place similar trades at similar price levels, those footprints combine into something measurable. This is known as order concentration. Price doesn't move randomly. It moves toward areas where liquidity is available, where orders cluster, liquidity forms, and liquidity attracts price. It's important to be precise. Algorithms do not know individual traders. They don't see identities, screens, or account balances. What they process is probability. They recognize that breakouts attract buyers. They recognize that obvious highs and lows hold stop losses. They recognize where fear, greed, and urgency tend to appear. Price is then guided, sometimes subtly, sometimes aggressively, toward those zones, not to target individuals, but to efficiently fill orders. This explains why markets often move before news becomes public. Large participants position early. Retail reacts later. By the time a setup feels confirmed on a chart, much of the move may already be complete. This is not a failure of intelligence, it's a consequence of structure. The mechanism appears across all asset classes: in forex around session highs and lows, in equities near earnings levels and pre-market ranges, in crypto around round numbers and funding imbalances. Different markets, same underlying behavior. Price seeks liquidity, not opinion. Professional traders tend to focus less on prediction and more on context. They study where traders are likely trapped, where exits are clustered, and where risk becomes forced rather than optional. This video does not suggest a trading strategy. It explains a market concept. Understanding structure does not eliminate risk. It helps frame it. To be clear, trading carries risk. No method guarantees profits. Losses are part of market participation. This content is provided for education only, not as financial advice or a recommendation to trade. If you found this breakdown useful, like, subscribe, and continue learning responsibly.